This video is looking at the budget example that is uploaded in my.wordpress. So this Word document and the Excel spreadsheet are in Excel. Just going to go over it briefly so you can see where I'm pulling some of the numbers from. So we always start with the sales or the revenues budget when we're looking at an operations budget. So from this example, we see that we're going to sell 2,000 regular and 3,000 deluxe. So we have 2,000 regular units and 3,000 deluxe. We have a selling price of $120 for the regular and $195 for the deluxe. That gives us projected revenue of $825,000 for the period. We take that, then, our number of units, and we move to the production budget. So what we want to see at the production budget is we want to see what our targeted ending inventory is for units. So we have a targeted ending inventory in units of 400 for the regular and 600 for the deluxe. So we've already added our budgeted unit sales, and then we have our target inventory of 400 and 600. From that, we will deduct our beginning finished goods inventory. Our example tells us that we have 250 beginning inventory of regular and 650 of deluxe. Now we have a production budget. We need to produce, in order to meet our sales goals, we need to produce 2,150 units of our regular product and 2,950 of our deluxe. We take those units from our production budget and go to our direct materials budget. So we have this information here. What we're going to use in budget is it tells us what we're going to use in production, that we have our requirements. We see here we have cloth requirements of 1.3 yards for each item for regular and 1.5 yards for deluxe. We have beginning inventory of cloth and wood, and we have a target ending inventory. So we're going to add our target ending inventory. We have 386 yards of wood, or cloth, and 295 of wood. Then we're going to deduct our beginning materials inventory. So it tells us that we have beginning inventory of 610 yards of cloth and 800 feet of wood. When we fill that out, we know that cloth costs $5.25 a yard. And so we've taken the amount that we need to be purchased in order to make our required ending inventory levels and the amount that we need for production. Take that times the cost per yard, and that tells us we need to spend $36,729 on cloth. We do the exact same thing for the amount of wood that we need, and that gives us our direct materials budget. Our direct labor budget uses the number of units that we're going to produce, takes them times the manufacturing labor hours per unit, which has all come off of this example. So we need 5 hours for regular and 7 hours for deluxe. We have a rate of $15 per hour, so our total direct labor costs for the month are $471,000. We also go to the manufacturing overhead budget. So we use activity-based costing for this company. We use labor hours for processing and units produced for our inspection, and then it tells us that we have setup hours per batch. So we have 2 hours per batch for regular and 3 hours per batch for deluxe. So what we need to determine is how many batches do we have? So for setup hours, we use a rate of $18 per setup hour. For processing, we use direct manufacturing labor hours, so we use $1.80 per direct labor hour. And for inspection, we use the number of pairs of sandals we're producing. We have $1.35 per pair. So the information we need now is how many batches does it take to create a pair of sandals. So we have each batch makes 50 pairs of sandals. So if we take the amount that we're going to make divided by 50, we get how many batches. And our production divided by 50 gives us our number of batches. And to get our batches per hour, let's take that number times the number of hours. Now we have our manufacturing overhead budget. We get to our ending inventory budget. This budget has all come from different information. So we know that we have a cost per unit of output. We need 1.3 yards for the regular and 1.5 for the deluxe. So if we add up all of the costs that we have, we end up with a total of $92.90 for our regular and $142.91 for our deluxe. Then we have the cost per unit for cloth that gives us what the ending inventory of direct units are, and the finished goods, regular and deluxe, times ending, this is our projected ending inventory, times the cost per unit. From there, we go to our cost of goods sold budget. This budget is built from information of the other budgets. So we have our total cost of goods manufactured from our direct materials used, our direct manufacturing labor, and our manufacturing overhead. We subtract the ending finished goods inventory, which we calculated on the previous budget, and that gives us our cost of goods sold. Then we look at our selling and administrative expenses budget. So our problem tells us that our selling and administrative expenses are 8% We have marketing and general administrative expenses that are 8% of sales revenue. And then we have shipping, which is based on the number of shipments and is $15 per shipment. Well, we know that our shipment is 40 shoes per shipment, and it's $15 per shipment. So we take the number of shoes, the number of shipments, divide by 40, so we ship 40 pairs of sandals per shipment. And we get our selling and administrative expenses budget. Once we have all of those budgets done, we can create our budgeted income statement with the information from the previous budgets. Just making the formatting look prettier. Once we have a budgeted income statement, the next is the cash budget, where we look at what are our cash receipts and what are our cash expenditures. So this is not completely filled in. So we want to look at what information do we need for our cash budget. Does this give us anything that we want to look at? So here we have the information for the cash budget. So it tells us all sales are on account. 60% are collected in the month of the sale, and 38% are collected in the following month. 2% are collected and written off as bad debts. Okay? So when we're looking at, we have our collections from June accounts receivable. So that's what we have is 60%. So what we need to determine is what we're going to collect from May. So we have 38% are collected in the following month. We need to go look at our balance sheet and see how much we're going to collect off of that accounts receivable. So we already have allowance for bad debts so our accounts receivable net is $307,800. That is as of May 31st. So it tells us that we're going to collect 60% in the month of May, which we did for May, and then we're going to collect the remaining 40% minus a 2% bad debt. So if we double check that, take 324,000 times 0.2%, that's $6,480. So our current allowance for doubtful accounts has more bad debt in there from previous months. So that 324,000 times 0.2%, and then we subtract that, it tells us that we're going to collect from May account receivables $317,520. Okay? Then we also need to figure out what our purchases are. So all purchases of materials are on account. We pay 80% in the month of the purchase and 20% in the following month. So I have for June, we have 80% of the direct materials budget. So what I need now are the accounts payable from May's purchases. So we have an accounts payable of $15,600. All of that is going to be paid. We have all other costs are paid in the month incurred, including the declaration and payment of a $15,000 cash dividend in June. So we've said that in June, we're going to pay a $15,000 cash dividend. We make monthly interest payments of 0.5% on a $150,000 long-term loan. So 150,000 times 0.5% is $750. sorry. Got distracted by that interest expense. The last thing we need on our cash budget is taxes. So it said that we plan to pay $10,800 of taxes owed as of May 31st in the month of June. Okay. $10,800. That gives us an ending cash balance for June 30th. We would use that information to create a budgeted balance sheet. So we have the cash, we have our accounts receivable, additions to allowance for doubtful accounts, our direct materials ending inventory, we have our property, plant, and equipment we've created. So it says that I've also added, we have accumulated depreciation from our previous balance sheet. And then it tells us to add 30% of the processing, setup, and inspection costs and 10% of the marketing and general administration and shipping costs. So 30% of the overhead costs and 10% of the marketing and general administrative costs go into our accumulated depreciation. And now we have a full operating budget.